So why do we care about the role that the central bank and banks play in the macroeconomy? Well, one of the most important prices in the economy is the interest rate. And remember, the interest rate's important both for borrowers and for lenders. And so the central bank targets something called the policy interest rate. And the policy interest rate is the interest rate on base money that banks will borrow and lend to each other, or that the central bank will borrow and lend directly with banks. People like you and me don't really care so much about the policy interest rate. That's not the interest rate at which we're going to get to borrow. What the interest rate that will affect us is the bank lending rate. And of course, there will be actually lots of bank lending rates. Sometimes you'll see something referred to as the prime rate, which is kind of a base interest rate in the economy. Um, the bank lending rate is going to be very important because it's going to determine the price of borrowing. So a lower interest rate makes it cheaper for borrowers to borrow, but less attractive for lenders to lend, whereas a higher interest rate is the opposite. The importance of the policy interest rate is that if that represents sort of the cost of funds for a bank, then they are going to be influenced by the policy interest rate when they're setting the bank lending rate. So if the central bank lowers or raises the policy interest rate, the bank lending rate will go up or down as well, and then that will influence borrowing and lending on a large scale and will therefore influence spending, especially on big ticket items like appliances, cars, trucks, houses, etc. In the United States, the policy rate is called the federal funds rate. And it's called the federal funds rate because the reserves that the banks have with the Federal Reserve are called federal funds. And so that's the rate that banks will charge each other when they are borrowing or lending reserves or federal funds. In the United States, the central bank does changes the amount of reserves and therefore the interest rate by buying and selling bonds through what's called the Federal Open Market Committee. And then they target an interest rate, a federal funds rate, and then the New York Federal Reserve buys or sells usually treasury bills, sometimes other assets, in order to influence the federal funds rate. There's also another interest rate in the United States called the discount rate. And the discount rate is usually a little bit higher than the federal funds rate, but it's the rate at which banks can borrow directly from uh, the Federal Reserve, from the central bank. And so the idea is that the central bank doesn't want to be the one borrowing, or excuse me, be lending to banks. They prefer banks to borrow and lend to each other. But if there's a financial crisis, and banks stop lending to each other because they're worried that other banks might go out of business, the central bank will step in and lend to banks at the discount rate. So if we think about where banking profits come from, their revenue comes from interest they get and repayment of loans, right? So that's mostly where their income comes from. Although recently, especially in the United States, things like fees on your banking accounts have also gone to bank revenue. Bank's costs include both, the regular operational costs, the salaries of everybody who works at the bank, plus, all the upkeep of the physical branches, but then also interest costs, right? So paying interest on all of those liabilities, so mostly deposits, but they also have other borrowing. And so the expected return that banks get is the return on the loans, taking into account the fact that some of those loans are going to be defaulted, right? And so they model that, they expect that, and so that goes into what their expected interest return is. So if we look at sort of a stylized balance sheet for a bank, then if we look at the liabilities over here on the right-hand side first, they might have 50% of their liabilities be deposits, 30% be secured borrowing, so that could include borrowing from other banks via the money market, and 16% be unsecured borrowing. So they might have total liabilities of say, 96% of their assets. Their assets, they might have cash in reserve of only 2%. This would be more of a European bank than a United States bank. For the most part, US banks have to keep about 10% of their deposits as reserves. They might have financial assets, right? Government bonds or corporate bonds of say 30%, loans to other banks of 11%, loans to households and firms, so mortgage loans, car loans, business loans, etc., of 55%. So that's the bulk of their assets. And then their fixed assets, the branches, etc., computers, what everything else they might have of 2%. And so that would give 100%. So in this case, the net worth would be 100% minus 96% or 4%. And so what we'll see is termed as leverage, which is assets divided by net worth, in this case would be 25. And you'll see that net worth for a bank is generally much lower than it would be for another type of company, like a car company or another type of manufacturing company. So the net worth is assets minus liabilities, and that's also called equity. It's right. It's how much is owned by the shareholders, whoever is the owner of the bank. When those assets fall below liabilities, then the bank is insolvent, just like any other company. If their assets are below their liabilities, they have to go through bankruptcy. And that can be a big problem, obviously, for a bank, and caused even bigger problems when we didn't have deposit insurance. How likely that is going to depend on leverage, right? And so leverage is total assets divided by net worth. So as net worth gets smaller and smaller as a percentage of total assets, leverage goes up and up. Now, from making profits, you want to have high leverage because you're basically using all of those assets you have in order to make more profit. But from a risk point of view, from a likelihood of insolvency, higher leverage makes it much more likely that you'll be insolvent because you only need a small drop in the value of your assets to become insolvent. So if we go back to this balance sheet, they only have 4% net worth. So if the value of these assets falls by more than 4%, all of that net worth is gone. And now their assets are worth less than their liabilities, and this bank is bankrupt, right? And this was one of the big questions in the financial crisis, was banks had a lot of these assets, which especially were mortgage-backed securities that nobody would buy. And so how much they were worth was a big question. And it was unclear whether or not a lot of these banks were technically bankrupt. And frankly, what happened was that the Federal Reserve stepped in and started buying those assets, where usually they would only buy, treasury bills, and so kind of rescued the economy that way. So when we think about why the policy rate is important, it's important because if we go back to Julia, when she faced a lower interest rate, right, when she faced an interest rate of 10%, she was able to borrow more and spend more now than when she faced a policy rate of 78%. And so if we put consumption now on the horizontal axis and the interest rate on the vertical axis, we get this downward sloping curve that says if the central bank can lower interest rates, it can increase spending now. And this is going to be important when we think about what the government should do when we're in a recession, for example, because in a recession, there's usually not enough spending in the economy. And so if the central bank can lower the interest rate, it will be able to increase the amount of spending now and help the economy recover from the recession.